morning. My name is Richard Young. I am the President and CEO of i-80 Gold. i-80 Gold has 4 past producing properties in Nevada. Measured, indicated, and inferred total 14 million ounces of gold and over 200 million ounces of silver, which makes us one of the largest resource holders in Nevada. And over the course of the next 5 or 6 years, we're going to go from less than 50,000 ounces of gold production per year to between 600 and 700,000 ounces of gold. We've largely put the recapitalization plan in place. We've raised the equity. Now we're focused on the debt, and that should allow us to move through the end of the decade and complete both phase 1 and 2 of our development plan and set us up for phase 3.
Richard, good to meet you. First time we've met at Spike, and say, look, I appreciate you coming on the platform. Maybe start off for folks who don't know who you are. Where are you from? What have you done, especially relevance to what you're doing today?
So I'm an accountant by training. I joined Barrick Gold in January 2nd, 1991. They had 25 employees in their corporate office, and I was the only one not married without kids, and so I put my hand up and I worked in every department for nearly a decade and a half. And then I left with one of the senior individuals, Alan Hill, who had built all of Barrick's mines over a 20-year period, and we worked together for the next 20 years essentially, including IPOing Teranga and taking that from a small producer to a mid-tier producer producing about 500,000 ounces per year. And that was sold to Endeavor Mining to form a new senior gold company. And I think that experience and the team that I'm with here, in part, is that group that we worked with at Teranga. So in terms of, having to fund, a development plan, our team has had to do that, as well as the technical skills to be able to put feasibility studies together, permit them or re-permit them, and then move into construction operation. So we've got all the skills that are required combined with the original i-80 team. So I joined last September, and the group that I've worked with historically, some of them for 20 years, joined with me, continued through, and the final hire was our Chief Operating Officer, Paul Chowrun, who joined April 30th of this year. And I would say that he is the strongest mining engineer technically that I've ever worked with. So he's incredibly competent at what he does, and we've got, combined with Paul, we've got the finance team that's done a lot of debt raises in the past, as well as a very good general counsel, some very good strategy and IR people, and a big finance group. So it's a good group. There's about 8 or 9 of us that have worked together, and we're based here in Toronto. And then we've got a great Reno office with, I refer to them as Nevada Royalty. They've operated some of the largest gold mines in Nevada over the last 20 or 30 years. So we've got a great team.
You're confident in the ability to execute on a plan. You've got some pretty big target. Your target's getting there, 600, 700,000 ounces is no small feat. So talk to me about maybe the assets that you've got today. When you've obviously walked in, you had the choice of jumping aboard or not. What did you see that you liked?
Initially, when I first got the call, I wasn't so sure because I didn't really understand what the strategy was. And then before accepting the job, I traveled down to Reno and I sat with the team and we put the development plan together that we laid out with the Q3 results. And we also talked about the risks and opportunities within the asset base. And I got very comfortable with the team, the plan, and our ability to execute. It's not very often that any management group has the opportunity to, work with tier 1 assets in a tier 1 jurisdiction to create a new mid-tier gold producer. Those opportunities are few and far between. And what makes me very comfortable with this opportunity is it starts out with the geology. The geology in Nevada is very homogeneous. So when you look at our resource, we don't have anything actually in reserves today, but we've got infill drill programs underway that will bring that resource into reserves. And what we're seeing is essentially a one-to-one move from a resource to a reserve. And so the geology is easy and straightforward. We've got 4 past producing mines. So they've already been permitted, they've already operated. So we're simply re-permitting them. So the permitting risk is low. And because these are restarts, generally speaking, there's a lot of infrastructure already in place. So the capital intensity to bring these mines back into production is low. And there's no new technology that is involved here. And it just makes it, from an operating standpoint, much lower execution risk than you generally find with a greenfields project anywhere else in the world that you might operate.
They're former producing mines. All the kind of above surface stuff is a bit easier as you're laying out there. I guess I'm interested in sort of trying to see how you view the underground risk, because these are sort of complex mines as well, in the underground. So how did you see these sort of coming together and sort of building up and working towards the 600, 700,000 target that you've got? Are you doing that out of the gate? Are you phasing this thing? How do you plan to get after it?
Right. So we've got 3 phases. So we have 3 underground mines, and the material is refractory, which means it needs to be processed either through an autoclave or a roaster. Okay? And combined, those 3 underground operations have between 3 and 4 million ounces of gold resources. And we would expect roughly about a 10-year mine life based on what we know today, and about 250,000 ounces per year once all 3 are up and running. Now, the ground conditions in Nevada are poor. 30 years ago, when I worked for Barrick and we were building the Meikle mine, which was the first underground mine in Nevada, it was difficult. But coming back now 30 years later, there are a number of underground mines across the state, and they've got the skill set to mine these underground operations quite well and quite cost effectively. So we're currently ramping up our first underground mine. We're using a mining contractor, a local contractor, and they are excellent. Now, at that underground mine, it's Granite Creek, we do all of the mine planning, grade control. They simply do the blast, mining, and hauling for us, and they're doing a very good job. And at that first mine, we are outperforming the reserve model, and we expect as we move further to depth within that deposit, the deposit's going to get better. But when you look at these 3 underground mines, they're just portal developments. They're not shafts.
Yeah.
So the capital required to develop these underground mines is roughly about $40 million to develop each portal, as well as the development. Portals are about $25 million in initial development, and then you've got another 15 as you start to work through and provide enough working areas underground. So they're not capital intensive. We've got the skills in Nevada. So the contract miner that is currently working our first underground mine that we're commissioning has been awarded the contract and is expected to start development of our second underground mine September 1st. So these mines are close in proximity. The team that's doing the mine development and operations know these ground conditions well and are very effective at the mining in these type of conditions.
Sticking with the kind of how do you kind of commercialize this and how do you kind of build it up and drive those revenue flows? Again, given the nature of the ore bodies and also the data that you have on the presumably, I think there's a data on the previous mining operations, but the company's also spent a fair bit of money itself, and you've got a fair bit of money that you raised earlier this year. So, what do you need to do in terms of being able to better target future drilling, and what do you need to do to better inform the plan as you've just laid out, phase one, two, or three? I'm intrigued about the data analysis component of where you're at.
So what we put out at the end of the first quarter were preliminary economic assessments, which by definition is not a feasibility study, so it's not done to that detailed level. And what we said at the time was that we viewed those initial PEAs and the cash flows that are associated as conservative. And as we completed the feasibility studies, we felt that they would do better, that we would show better results. So the biggest outstanding item is an infill drill program. So we have just completed the infill drill program earlier this year for one of our 3 underground mines. We'll have a resource and reserve update shortly, and it will demonstrate the fact that as we infill, the ore body gets bigger and it confirms the grade. So when we put out the updated reserve and resource statement for that mine, it'll be better than what we had included in the PA. We've got infill programs, drill programs at a second underground that began in June. We've got 5 drill rigs drilling today. We'll complete that feasibility study in the first quarter along with Cove, which is the one that we'll have the resource for within the next few weeks. So by the first quarter, 2 of the 3 underground mines will have the feasibility studies. That is the highest level of study that you can do for a mining operation. And we would describe these as bankable. Again, as we look to raise third-party debt, the feasibility studies have to be done at the highest level because we'll be using external capital. So we'll have 2 of the 3 feasibility studies for 2 of the 3 underground mines. The third one, we're going to start an infill drill program in the third quarter on the upper zone, first quarter on the lower zone of 2026. I think we're looking at about 175,000 feet of drilling, and that feasibility study will be completed either in late 26 or early 27. So that will give you our base case for the 3 underground mines, and they're all open at depth and along strike. So we do expect, as we start to develop these underground mines, we will be able to extend the mine lives. It's much more cost effective and more accurate to drill from underground than it is from surface. So generally speaking, when you've got an underground mine, you want to do sufficient drilling from surface to warrant an exploration drift to do some further drilling, but you only drill enough to get started. And then ultimately, as you move underground, you'll continue to drill and extend that mine life.
Have you got this confidence of leaping from PEA to BFS, DFS, you want to call it that, because of the historic data that you've got, the way that these assets have been mined previously, or have there been sort of changes or additions to your thinking technically, which says you've got the confidence to be able to, I guess, accelerate the process through to revenue, which the market is rewarding, so I can see why you want to do it, but where's that confidence coming from?
Well, you're right. These are all 4 past producers, so there's a lot of geologic knowledge. But the other element that is different in Nevada than it is in many other places that I've worked is generally when you look at a resource and you complete an infill drill program, you convert some portion of that resource to reserves, 30, 50, 60. Nevada, because of the type of geology you're looking at, we're likely looking at conversion ratios of at least 1 to 1, if not better than that. So the geology in Nevada is much simpler and straightforward than it is in many other areas of the world. We've already done a lot of metallurgical test work. As you mentioned, these deposits have previously been mined and processed. So there is a lot of historic data that gives us an advantage as we move forward with these projects.
Okay, and obviously you mentioned the refractory nature of this and how you'll have to treat that of roasters, etc., or autoclaves. Have you done any additional metallurgical work yourselves, and how representative do you think that is across all three mines?
So the metallurgy among the 3 underground mines is a little bit different each mine. And best practice anywhere in the world is to do metallurgical work throughout the ore body, because ore body metallurgies can change. So part of what our program is, moving from a PEA to a feasibility study, is completing the infill drill program, number one, but also completing that metallurgical test work so that we clearly have representative samples throughout the ore body so that we can properly blend the material through the autoclaves as we mine it.
Right. Okay. And obviously you'll be, I guess, with the feasibility study firming up on the costs and the funding required. I suspect, you think in a market like this, the money's going to be there when you need it.
We raised equity in Q2, call it net $175 million US. With the warrants that are in the money, that's about $300 million in total. We have another potential $100 million that'll come through cash that's held up on the balance sheet that is restricted today, but by 27 or 28 will be back and available for use, as well as some additional warrants from an earlier equity raise a year ago that will come due. So that's 400. We think we need about $800 million through the end of the decade. We're looking at a senior debt facility of about $400 million. And then we're also looking at the sale of a non-core asset, the FAD property, as well as potentially a gold royalty on Mineral Point, our largest open pit project. And that should give us between 9 and 950. So we're going to over-raise on what we need, but we think the equity dilution component is now behind us. So ultimately, with all of those warrants being exercised, we'll move from a little bit over 800 million shares outstanding to about 1.05 billion shares, which I know is a lot of shares outstanding, but there is a lot of value in the asset base. So we're looking to raise between 9 and 950. We've earmarked about 800 million in uses. And when you look at the uses, first and foremost, we have about $200 million in debt on the balance sheet today that we need to refinance. And then we've got $400 million, give or take, for the refurbishment of the autoclave. And we haven't really spoken about that, but only 2 companies in Nevada have autoclaves, Nevada Gold Mines and ourselves. And then the balance of $200 million is really to move everything through permitting, feasibility study, and development into operations.
It's been interesting sort of few years, last 3-4 years, when you're looking at the sort of inflationary pressures in the mining space, but also this last 18 months, gold has been on a tear, so swings and roundabouts. But here, where you've got a situation where you've got previous producing mines with old infrastructure, which you've explained the kind of process, the stage process that you're going to go through, and you've got a team that can execute. You've said that they're the best in the business. Is there any concern in your mind in terms of the cost controls that you're going to need to put in place, or you feel you need to put in place, when you look at some of the difficulties others have faced when building out their own production capabilities? Some have succeeded, some have not. What have you learned?
Yeah, so that's a great question. So back in a prior life, I I was not only involved in the late stages of building Gold Strike for Barrick, which was ultimately became a 3 million ounce mine. But I also was seconded from corporate development at Barrick to build a mine in Peru, and I was part of that cost control group. And, having worked with Alan Hill, who built all of Barrick's mines over a 20-year period, largely everything was built on time, on budget. And there are 3 or 4 reasons for that. One is the feasibility study is thorough, and I'd refer to it as bankable. So the start of, making sure that you can build the project on time, on budget, is making sure you got a great plan where you've done all the proper engineering, you've got the proper execution plan. That's where you start. And then you need a strong owners team. And that owners team mirrors your construction contracting team. Just, an extra set of eyes. Then you need to have really strong cost control. So that's what we are doing for example, for the refurbishment of the autoclave, which will be $350 to $400 million. It's being done by Hatch Engineering. Hatch has done all of the autoclave and roaster work in Nevada for 40 years. I worked with them when I was at Barrick, and they've put a very good team on. They've done a thorough review and put together a very comprehensive, detailed, bankable feasibility study, and we'll have that published in the Q4. So that's the start. We've already begun hiring our owners team, so the lead construction manager. This week we'll be putting a job offer out for the cost control individual that will work hand in hand with the construction manager. Beyond that, we've got Andy Cole that I worked with at Barrick, who built Barrick's autoclaves and roaster. So he's an advisor to the company. And then we've got Ian Ward, who actually was at Hatch leading the development effort of the autoclaves at Gold Strike back in the late 1980s, early 90s. So we've got strong advisors, we've got a strong owners team, and then Paul Chowrun, our chief operating officer, who's worked with Hatch before, is closely working with everyone to make sure that we've got the right execution plan and that we can execute on that. And so it's all about planning and making sure that you've done all the proper engineering to make sure there's no surprises. And then you've got the proper owners team and construction team to be able to execute, and you got to be able to measure it. And so when you look historically at projects that have worked out well, they've had all of those elements. So I've seen both good execution and unfortunately poor execution. So as you look forward, it'll be a belt and suspenders approach. That's one element, Matthew. I'm sorry for the long answer.
No, but it's important.
There's not a lot of capital required. Like the 3 underground mines, you're looking at $40 million in development infrastructure. And then there will be some dewatering attached to that, but those aren't high risk. They're not blowouts, right? Like if you encounter some pure underground mine conditions than you're expected, which we shouldn't because we've done the geotech drilling, you're talking about a few $1 million. You're not talking about hundreds of millions of dollars. So that's what in part makes this unique, is very low capital intensity attached to the restart of these projects.
Okay, and I appreciate what you just said as well. Just one last question on it, which is, you're the new guy, you're the head guy. This is on your shoulders. You laid out, as you say, it's very important to have your own team on this. How much of the historic technical work do you take on board, or do you validate it before you incorporate it into your own, to put your stamp of approval on all of the moving parts?
So look, there's been a lot of great work that's been done. The Reno team is very good. So when you look at the steps required, so in coming on board, we've completed the PAs. One element that is very important as we move from PA to feasibility study is to make sure that you've got the right third parties doing the feasibility work, the technical work, working with the company, doing proper gap analysis to understand areas where there might be additional work. And for example, Cove, one of our 3 underground mines that we're moving through the feasibility, SRK, which is a very reputable firm, identified more geotech drilling required. So that is just getting started this week and will be completed this fall. So, you go with name brand firms with very reputable team members that are very good at this so that you end up with feasibility studies that incorporate the historic information, and where there are gaps, we fill those gaps in. And so if you look at the original guidance we put out last fall for the timing of the feasibility studies, we're essentially about a quarter late for the first 4. And that is to ensure that based on the gap analysis, filling in some of the missing pieces where some additional work we believe is required as part of a belt and suspenders approach.
Okay. Phase 1, phase 2, phase 3. So for phase 1 is when do you look to try to get into production, and what sort of production levels are you hoping to achieve with that?
So phase 1, so we're ramping up our first underground mine, Granite Creek, and we're going to start construction September 1st for our second underground mine. And so we will ramp both of those up through the end of 2027. Production between now and the end of 27 is through a third party. We're toll milling, but we're losing between $1,000 and $1,300 an ounce just because of the margin with the toll miller, that once we refurbish our own autoclave at the end of 27, we'll get that margin back. So by 2028, we would expect to be producing between 150 and 200,000 ounces of gold per year from those 2 underground mines, processing that material through our own autoclave facility, and we should generate between $2 and $250 million of cash flow from phase 1 that will allow us to construct our next 2 mines as part of phase 2, the third underground and the first oxide open pit. And we expect to have that done by the end of 29, so that as we move into 2030, we're producing between 300 and 400,000 ounces of gold per year. And that'll be phase 2, and that's fully funded through this recapitalization plan that I've laid out. And then by that point, we would expect to have permits for Mineral Point. Mineral Point is going to be our largest, it's going to be our flagship asset. So the PA had 282,000 gold equivalent ounces, including the silver equivalent, for a 17-year mine life. But once we complete that infill program and the feasibility study, that'll probably be a 300 to 350,000 ounce producer for about 20 years. And so what we'll do at the end of the decade is we'll refinance the current debt facility to incorporate what our needs are to move forward with Mineral Point, which will be the largest capital project for us. It's a heap leach project, but there's a fair bit of stripping. It is an existing open pit mine, so we've got a year of stripping, and then we've got mobile equipment, leach pads to construct, and all in all, that's $900 to $1 billion over about a 3-year period.
Let's look at value. Let's look at where you're at. Let's look at your share price, the performance over the past 3-4 years. There's some distinct advantages to being a brownfield development operation, obviously, and you've raised a fair bit of capital at the moment. But the phrase which has caught my attention is self-funding through this phased approach. I don't necessarily think it's unique, but it's hard to execute on. what when do you think you'll start to get recognition for this? Do you need to get that first phase one out of the way, or do you think it's you should be valued better today?
I don't know, to be perfectly blunt with you. The PAs that we put out at $2,175 gold,
Done.
the NAVs were 1.6 billion US. At 2,900, it was 4.5 billion. Our internal target, once we complete the infill drill programs and the feasibility studies, is 6 billion US. Historically, Nevada mines have traded a premium to anywhere else in the world other than maybe now Western Australia. So how we move from, our current market cap of 600 million to 6 billion, I don't know. But what I can tell you is that, over the course of the next 12 to 18 months, we're going to have a feasibility study for the autoclaves, and we'll start moving that into construction. And we'll have feasibility studies for 4 of our 5 gold projects in the development plan. And we may have started the feasibility work for Mineral Point as well, the 5th. So at some point, as we move from where we are today, de-risk the balance sheet, completing the recapitalization might be a big one. Announcing the refurbishment of the autoclave, there is some concern that that number could be much higher than what we've guided. It won't be. But then it's all just about moving everything forward on a quarterly basis. And as you saw with this quarter, there was a bump, and there was nothing really spectacular. It was just continue to move the development plan forward and optimize the assets. So the hope would be that quarter over quarter, as we continue to move our development plan forward, the market gets increasingly comfortable that we can execute on this plan and we're delivering the value. So it'll be a quarter by quarter, process, I think,
Okay.
combined with a number of these studies coming out.
Okay. Well, look, Richard, I appreciate you kind of bring this to us and maybe talking through some of the kind of fairly, high level topics that we need to be looking at. We will certainly go away and have a look at what you're doing there, and maybe we could touch base again and maybe get into the weeds about. Appreciate your time today. Thank you.
Well, thank you.